Welcome back to the deep dive. Today, we're really digging into something fascinating. We've got this stack of sources that all point towards one big story.
Yeah, it's about power, really,
Uh,
and
e-
scale.
Exactly. And that moment, that often kind of ruthless moment, when a super innovative startup gets, well, not just bought, but almost swallowed whole by a giant corporate empire.
Right. We're looking at how these billion-dollar deals get made, the psychology behind them, the visionary founder versus the empire, that tension.
And it's not just about the money, is it? It's this fundamental clash, this struggle for control that happens long after the ink is dry.
Definitely. We're tracing this pattern, this desire to just eliminate uncertainty, eliminate competition. It's not new. We see it stretching way back, 19th century tycoons manipulating railroads.
Right up to today's tech giants basically buying out their own fear.
Precisely. Because that huge price tag, it's almost never about the immediate profit. It's about stopping a threat in its tracks.
And maybe getting something they just can't build themselves, that sort of magic ingredient.
That's it. That elusive cool factor, or maybe controlling a strategic bottleneck.
Yeah.
Something the empire needs but can't create internally.
There's this quote from a co-founder. It just nails the whole thing. He said, "I like to say I'm dangerous enough to know how to code and sociable enough to sell our company."
Oh, I know that.
He finishes, and I think that's a deadly combination in entrepreneurship.
It really is that mix. The tech genius and the salesmanship. Being able to build something incredible and then have the savvy to navigate the exit, to get that massive valuation.
That's what puts you on the radar for these huge acquisitions, right?
Absolutely. It's the combo that creates the kind of value these empires can't ignore. You could apply that quote to Andrew Carnegie, or as we'll see, the founders of Instagram, Kevin Systrom, Mike Krieger. Their story is really central to what we're unpacking today.
Okay, so let's start with the modern playbook. The Zuckerberg strategy, you could call it, especially highlighted by that Instagram deal back in 2012. Here's Facebook, massive reach, huge user base.
Billions of users, yeah.
But in the early 2010s, they kept trying and failing to capture that specific feel, that sort of quality that smaller, faster apps were nailing.
Right. That inability to just manufacture cool on demand.
Yeah.
That's the weak spot. Remember when they tried to build their own camera app?
Oh, yes, total flop.
It was meant to copy Instagram, the filters, the vibe, the whole aesthetic.
Yeah.
But it just didn't land. They had the engineers, the resources, but they couldn't replicate the magic, the cultural connection Instagram has.
So when you can't build it,
You buy it. Money becomes the weapon, the final product, in a way. You buy the threat, you buy the cool.
and once they admitted, maybe just internally, that they couldn't clone the culture, the offers got insane. We saw it again later with Snapchat, right?
Absolutely. Snapchat pops up,
Yeah.
starts capturing the younger demographic. Facebook tries to copy its features,
Yeah.
fails again.
And boom, the offer comes.
More than $3 billion, an astonishing number for a company at that stage.
And how it was structured is really telling, too.
Yes. Heavily weighted in Facebook stock. That's crucial.
Why is that so significant?
Because it shows the valuation wasn't based on current revenue or profit or even established market share, really. It was almost entirely based on future potential and, maybe more importantly, eliminating a future competitor.
So it's a preemptive strike.
Exactly. Using their own inflated stock price as currency to take a potential existential threat off the board. It was driven by fear, pure and simple, not just spreadsheets.
And this instinct, using huge resources strategically, it wasn't something Zuckerberg learned later. He had it right from the start, didn't he, with the Facebook?
Oh, incredibly early on. When he first expanded beyond Harvard, think about where he went.
He didn't just go big, he went strategic.
Right, Columbia, Stanford, Yale, what do they all have in common?
They already had their own social networks, little walled gardens.
Exactly. Existing established networks. It wasn't random, it was a deliberate test.
A market test in the wild. Can my product displace the incumbents?
Precisely. If the Facebook could go into those schools with strong identities and existing platforms, and win, then he knew. He had proof.
Proof that his product was better, stickier, more compelling.
Yeah. It proved it had what you call displacement value.
Yeah.
It could conquer anywhere else, especially places that didn't even have a network yet. It basically guaranteed eventual dominance.
It's fascinating how that mirrors the historical strategies. Eliminating uncertainty through sheer force or clever maneuvering, that's empire building 101.
Takes us right back to Andrew Carnegie and the steel industry. Think about the scale back then. By 1880, railroads were everything.
They drove the whole
And
economy.
they consumed enormous amounts of steel. 75% of all U.S. steel production was just for rails. Massive demand.
But also massive competition among steel producers.
Exactly. And Carnegie, much like Zuckerberg, wasn't just focused on making steel efficiently at his Edgar Thomson Works, his ET plant. His genius was also in locking down the market, securing sales, controlling the flow.
How did he do that?
Well, he cleverly built his new plant right near the tracks of a major railroad, the Baltimore and Ohio, the B&O, strategic location. Then in 1875, there's an economic slowdown.
Okay, times are tough.
Right. So Carnegie personally goes to see the president of the B&O, John Garrett. He wants to sell him steel rails.
But Garrett's probably hurting too, right? Railroads feel the pinch.
Exactly. Garrett was hesitant. The B&O was struggling, couldn't afford a big switch to steel just then. So Carnegie plays it smart.
He doesn't push for a huge order.
No. He asks for a small order now to prevent the stoppage of our works during the winter months. Sounds reasonable, almost like asking a favor.
But it wasn't just a favor.
Not at all. It was a calculated move. He reframed the whole deal. He argued it was actually in the B&O's own interest to buy from him.
How?
He pointed out that if his steel mill shut down for the winter, the B&O would lose all the money it made shipping raw materials to his plant, especially coke coming into Pittsburgh.
So keeping Carnegie in business meant keeping their own freight revenue flowing.
Precisely. He basically said, give me a small order now, keep my plant running, and you protect your own future profits from hauling my raw materials. It turned a potential cost for the railroad into a strategic investment in their own bottom line. Just masterful.
Wow. That's market control through smart leverage.
And that need for big capital, big moves, whether it's Carnegie securing a rail order or Facebook buying Instagram, leads us to the financial engines behind these deals today. We need to talk about LBOs, leverage buyouts.
Right, because they really fueled the environment for these massive acquisitions. Can you break down what an LBO actually is?
Sure. Basically, an LBO is when a firm, usually a private equity firm, buys another company using a ton of borrowed money. That's the leverage part.
Okay, lots of debt involved.
A lot of debt. And often, the assets of the company being bought are used as the collateral for that debt.
So the company itself guarantees the loan used to buy it.
In essence, yeah. The goal for the buying firm is to use as little of their own money, their equity, as possible, and then use the target company's cash flow or asset sales to pay down that debt quickly. This magnifies their return on that small initial investment.
Got it. And the timing for the LBO boom, particularly after 2000, was really important.
Crucial. Remember the dot-com crash. Investors got burned badly. They completely lost their appetite for those visionary dot-coms with no revenues or profits.
Yeah, the hype died down fast. People wanted something real.
Exactly. Certainty. Stability. So capital shifted away from speculative tech back towards, well, boring businesses, companies that actually made things or sold things reliably.
Soap, not dreams, as you said earlier.
Pretty much. And firms like Blackstone saw this shift. They jumped on this renewed desire for stability. They got incredibly aggressive just as the U.S. economy started picking up after the recession around 2003.
How aggressive?
Blackstone alone led deals worth $16.5 billion in 2003. They were capitalizing on the market mood, which demanded mundane businesses, provided that they produced steady income.
And those were the perfect targets for LBOs.
Perfect. Stable cash flows to service the debt. Predictable markets. And because these private equity firms were raising so much money, these huge funds, they couldn't really bother with small deals anymore. The transaction costs were too high relative to the potential return.
They needed bigger targets to deploy all that capital.
Had to. They needed bigger, more significant acquisitions. And that dynamic, using massive amounts of borrowed money to buy up stable, cash-generating companies, or sometimes strategically important ones like Instagram. That's the thread connecting the old industrial tycoons and the modern financial players who fund today's tech empires.
Okay, so the deal gets done. Instagram is part of Facebook. What happens next? Because this is where the real tension starts, right? The founders, Systrom and Krieger, they're suddenly incredibly wealthy.
Beyond wealthy, yeah. But they didn't just want the money, they had a vision.
They still wanted Instagram to be something special.
Exactly. They saw the acquisition, that $1 billion, as fuel, resources to make Instagram big, powerful, and important one day, as they put it. They still saw themselves as visionaries.
With their own brand, their own way of doing things, separate from Facebook.
Right. A different brand and ethos. That was the dream. But they were now inside this massive corporate machine, the Facebook mothership. And the clash began almost instantly.
There's that story about the celebration.
Yeah, right after the deal closed. Understandably, the small Instagram team was ecstatic. They had a little celebration. Maybe you got a bit carried away. Some designers came back to the office, reportedly tipsy.
And Systrom wasn't happy about it?
Reportedly, no. He was dismayed. He apparently confronted them.
What did he say?
The message was blunt. Something like, "We didn't hit 1 billion users. Time to get back to work."
Wow. Talk about setting the tone.
It really signals his mindset, doesn't it? The billion-dollar acquisition wasn't the finish line. It wasn't even a milestone worth celebrating excessively, in his view. It was just ammunition.
The real goal was total domination, 1 billion users, exponential growth.
That seemed to be the target. And achieving that, especially within Facebook, but trying to maintain independence, required intense focus, ruthless prioritization even.
What do you mean?
Well, Systrom knew they had limited resources, even with Facebook's backing, relative to the potential user base. He told the team they couldn't be everything to everyone. They had to choose where to put their energy.
So, strategic focus.
Highly strategic. They decided to really cultivate relationships with very specific, influential user groups.
Which ones?
Fashion communities, professional photographers, musicians, and crucially, teen groups. These were the tastemakers, the trendsetters, the groups that defined cool on the platform.
So they poured resources into connecting with them, building features for them.
Exactly. Dedicated outreach, development time, everything focused on cementing Instagram's place within those core cultural hubs.
And the flip side of that focus
Was consciously deciding not to prioritize other big communities on the app. Think food bloggers, travel influencers, home design accounts. Very popular, but
they actively chose to ignore them or just not focus on them.
the latter, but it was a deliberate strategic choice. Systrom apparently reasoned that reaching out significantly to those groups would create an expectation, a sort of implied promise of long-term support, features, community management.
And they couldn't afford to make promises they couldn't keep.
Not if they wanted to maintain focus and control over the product's core identity and direction. It was a classic startup move. Maintain purity, stay lean, don't overextend, even when you're inside a giant that wants you to grow everywhere all at once. It highlights that struggle, product integrity versus the empire's demands.
That fight for control, for keeping the product vision pure. It reminds me of Steve Jobs.
Oh, absolutely. Jobs was the master of the proprietary ecosystem. The iPod and iTunes, that whole strategy was built on control.
I walled garden, as they say.
Totally. He flat out refused to license Apple's FairPlay DRM, the software that controlled song playback, to any other hardware makers.
So if you bought a song on iTunes,
You had to play it on an iPod, period. And just as importantly, he blocked other online music stores from selling songs compatible with iPods.
locking people in, fair play was the key, the bottleneck.
This was the technological linchpin of the whole strategy. Total control over the user experience from purchase to playback.
Did people push back on that?
Oh yeah, lots of criticism. There was a Harvard Business School professor who publicly warned Apple about it.
What was the warning?
Basically that this closed, proprietary approach was repeating Apple's mistakes from the 1980s computer wars. That insisting on this tight iPod iTunes link would ultimately make the iPod a niche product.
History proved that wrong, didn't it?
Massively wrong in that case. But Jobs stuck to his guns because for him, controlling the whole experience was paramount. It was about the product identity and maybe his own identity intertwined with it.
That level of personal investment, that founder ego, when it goes unchecked, it can really shape a whole company culture. Sometimes not for the better. Thinking about WeWork here.
A prime example. Adam Neumann was described as being firmly in his control. The power was centralized with him.
And the board didn't push back.
Reports suggest they often would eventually bend to his will, even on major financial decisions. There wasn't effective oversight.
And the company culture reflected that personalized power. Right. There's that infamous toast.
Right. At an executive retreat, apparently Neumann wasn't happy with the food, sent it back, and then, sort of holding court, raised his glass. The toast. To nepotism. Seriously. Celebrating hiring friends and family, valuing personal connections over maybe qualifications or standard corporate practices. It just perfectly shows a CEO putting himself and his network first, blurring the lines between personal power and corporate governance.
All while trying to project this image of a world-changing company.
Exactly. And even when things end well financially, that personal investment, the emotional side of these power struggles, It lingers. Look at Elon Musk after the PayPal sale.
That was a huge exit. $1.5 billion to eBay made him incredibly wealthy.
Right. But even after that massive success, what consumed him? The internal battles, the rivalries during PayPal's early days?
He couldn't let it go.
Apparently not immediately. There's this story, maybe apocryphal, maybe not, but it's powerful. Musk supposedly called Max Levchin his former rival within PayPal.
After the deal closed, after they were both rich.
Yeah. And the question he asked was just heartbreaking, really. He asked, "Why did you turn on me?"
Wow. Sitting on millions, maybe hundreds of millions, and that's what's on his mind.
It just shows how deeply personal these ventures are. The stakes feel existential, even beyond the money. That sense of betrayal, the emotional cost, it can absolutely outweigh the financial windfall. These aren't just business deals, they're deeply human dramas.
So this drive to consolidate, to dominate the market, it's clearly baked into the history of business long before tech.
Oh, absolutely. It's the fundamental logic of building an empire, whether it's railroads or software. You need financial muscle, strategic alliances, and ways to enforce control.
The classic example has to be John D. Rockefeller and Standard Oil.
The master. His goal was total control over oil transportation. That was the bottleneck back then. If you controlled the transport, you controlled the industry.
And he achieved that through the railroads.
Through a brilliant, and some would say ruthless, alliance with the Pennsylvania Railroad, one of the most powerful entities of its time.
What was the deal?
Standard Oil guaranteed the railroad massive volume, agreeing to ship at least 2 million barrels a year. That's huge. Guaranteed business for the railroad.
Okay, so the railroad gets volume. What did Rockefeller get?
This is the genius part. Standard Oil was designated the evener, the enforcer of the whole railroad agreement system for oil transport.
The evener. What does that mean?
It meant if any other railroad tried to cut prices to steal Standard Oil's business, Rockefeller, as the evener, could demand even bigger discounts or rebates from the other participating railroads, effectively punishing the competitor.
Whoa. So he could use the entire railroad cartel against any single railroad that stepped out of line?
Precisely. It guaranteed him massive rebates on his own shipments, making his costs lower than anyone else's, and it basically ensured no railroad would dare challenge him. He effectively controlled the transport system. He had a stranglehold.
That kind of power play requires immense financial clout to even get to the table.
Immense. And that holds true across different eras. Think about Cornelius Vanderbilt, the Commodore, another titan. There's a story from October 1853. One of his associates, Robert Schuyler, got himself into deep trouble. Overextended on stock speculation, facing financial ruin. Vanderbilt steps in,
Bails him out.
lends him $600,000,
How much was that back then?
an almost unimaginable fortune. It was roughly equivalent to the entire estate of a very, very wealthy merchant at the time. Just gone, in a loan.
So only someone with Vanderbilt's level of personal wealth could even consider doing that.
Exactly. It shows the scale of private capital needed back then to stabilize markets, acquire major assets, or even just prop up a key player like Schuyler. You needed imperial levels of wealth.
Where do we see that kind of scale today? Obviously in tech buyouts, but elsewhere.
Global commodity trading, absolutely massive scale there. Take a company like Vitol. By 2019, they were handling something like 8 million barrels of oil and refined products every single day.
8 million barrels a day. That's staggering.
It is. And as one of their execs famously said, just bluntly, size matters. In those volatile global markets, sheer scale gives you stability, negotiating power, market intelligence, dominance.
And when companies get that big, generating those kinds of massive, almost monopoly-level cash flows, what do they do with all that money?
Often it leads to something observers sometimes call random diversification, especially noticeable in these huge conglomerates, particularly some built by powerful families in Asia, sometimes called Asian godfathers.
What does that structure look like?
You might have a core business, often something heavily regulated with near-monopoly profits like telecom or banking or utilities, maybe secured through political connections.
Okay, the cash cow.
Right. And then surrounding that core, you might find literally hundreds of other private companies controlled by the same family or entity, spanning dozens of completely unrelated sectors: real estate, manufacturing, retail, agriculture, you name it.
Seems inefficient, almost random, like you said.
From a purely operational synergy perspective, maybe. But it's not about efficiency. It's a defense mechanism.
How so?
That massive diversification across different industries and often across different countries acts like insurance. It protects the core wealth.
Insurance against what?
Political risk, mainly. In case the political winds in a godfather's home state blow from a different direction, as one analysis put it, if you lose savor with one government or one sector faces a downturn, your wealth is spread out. You're diversified geographically and sectorally.
Too big and too spread out to fail easily, regardless of political shifts.
That's the idea. Protect the core profits generated by those often license-based monopolies by spreading the risk far and wide.
This relentless focus on profit, consolidation, diversification, it feels like it leads us to the underlying philosophy of a lot of modern corporations.
It really does. And a key moment, a foundational text for that philosophy came out in 1976, a paper by two economists, Michael Jensen and William Meckling, called Theory of the Firm.
Okay, sounds academic, but it had real-world impact.
Massive impact. It fundamentally reshaped how people thought about the purpose of a corporation and the role of its executives.
What was their core argument?
They focused on what they termed the agency problem. Basically, the potential conflict of interest between the managers running the company, the agents, and the owners of the company, the shareholders, the principals.
Right. Managers might act in their own interests, not the owners.
Exactly. And Jensen and Meckling's proposed solution was pretty radical for its time and very influential. They argued that executives should essentially disregard all other stakeholders.
Like who? Employees? The community?
Yep, employees, communities, suppliers, the environment. Irrelevant. The sole duty of the executive, according to their theory, was to maximize returns for the shareholders. Full stop.
Wow, that's a narrow focus.
Extremely narrow. And it provided the intellectual justification for a lot of the management practices that became common in the following decades. Ruthless cost-cutting, prioritizing short-term profits over long-term investment, massive executive compensation tied to stock price.
They even suggested that focusing on things other than profit was a problem.
They did. They warned that executives might get distracted by, and I'm quoting here, frivolities such as personal relations, friendship, respect, and so on, with employees.
Frivolities. Respect and friendship are frivolities.
According to that purely financial maximization model, yes. Anything that didn't directly contribute to the bottom line for shareholders was a potential distraction, an agency cost.
So that created a kind of accountability vacuum.
You could definitely call it that. The CEO answers only to the shareholder, whose primary interest is assumed to be financial return. It shifted the focus dramatically towards short-term financial performance.
And that culture, that framework where quarterly results are king, where job cuts might even be seen positively by the market, that's the environment a successful founder, like Instagram's Kevin Systrom, eventually finds themselves in after an acquisition.
Exactly. The billion-dollar check buys entry into that world. But the price, often, is the original vision, the independence, the frivolities, like maybe a unique company culture or a focus beyond pure profit. That's the trade-off. Hashtag tag outro.
So when we pull back and look at all these threads, from Carnegie strong-arming the railroads to Zuckerberg writing that billion-dollar check for Instagram, there's this clear repeating pattern, isn't there?
Absolutely. Innovation happens, creates something new, something valuable, maybe something disruptive, and then the established power, the empire, responds.
Either by trying to co-opt it, buy it out with overwhelming money,
Or if they can, by crushing it outright.
and that huge price tag, the billion for Instagram, the $3 billion offered for Snapchat, it's not really about buying current profits.
Rarely. It's about buying the future. It's about neutralizing that fear, that existential threat. And it's often about acquiring something intangible, that cool factor, that user loyalty, that strategic position, something the empire realizes it just can't build itself no matter how many resources it throws at the problem.
They're buying time, they're buying potential, and maybe most of all, they're buying peace of mind, removing a competitor from the board.
Exactly. Which brings us back to that poignant moment in the Instagram story. Systrom's reaction to his team celebrating the acquisition.
Right. Being dismayed that they were celebrating the money, not the mission hitting 1 billion users.
It really crystallizes the conflict. Silicon Valley culture pushes relentless exponential growth. Total conquest seems to be the implied goal.
So the question these stories leave us with is, for innovators today, is just creating something amazing, something valuable, maybe something beautiful and sustainable, but not world-dominating. Is that enough?
Or does the prevailing logic, the logic of empire that we've traced from Rockefeller to Facebook, demand more? Does it demand that total victory, that exponential scale, leaving no room for smaller, perhaps more artistic or focused definitions of success?
It feels like the choice often boils down to keep your creation pure, but potentially smaller, or trade that purity for the massive scale and resources the empire offers.
And maybe the final thought for listeners is, when that trade happens, when the innovative startup gets absorbed into the giant, is the outcome truly a victory? Or is it just the inevitable price of playing the game in a world still largely defined by that enduring, relentless logic of empire? Something to think about.